Hey guys, in this video I'll be talking about why it's a really bad idea to buy in Western Melbourne and Western Sydney. So if you're about to book a lot, book a land, buy something that you'll build on later for investment purposes, really I suggest that you watch right through to the end of this video. My name's PK and I help people build passive income using data without needing to drop $15,000 on a buyer's agent. Guys, if you're looking to invest in property, smash that subscribe button, hit the notification bell, give this YouTube video a thumbs up, a like, and that way it will go to more people that will actually benefit, right? More people who will actually get value out of it. Thank you for joining in this episode. So there are 5 or 6 reasons why you really should think 3 times before starting your property investment journey or continuing your property investment journey in the western suburbs of Melbourne or the western suburbs of Sydney. You know, in Sydney, you know what I'm talking about. I'm talking about Rouse Hill, Richmond, Box Hill, all those kinds of areas. And in Melbourne, you know what I'm talking about, out past Truganina, out past around that Melton area, out past Tarneit. Really, I'll get to it, but there's about 5 or 6 things. So I'll be talking about positive gearing, I'll be talking about tax, I'll be talking about how much capital it takes, I'll be talking about vacancy rates out there, I'll be talking about the growth fundamentals, I'll be talking about timing the market, and I'll be talking about why friends may not be, although well-meaning, the best people to follow. So the first thing, positive cash flow. So if you look in Sydney, you just can't buy a positive cash flow property in the western suburbs. So I know you guys, you might be thinking, I have some money to spend, I have some capital, I want to start my investing journey. The reality is that buying a block of land that was going to cost you almost $1 million in Sydney, those western suburbs, then building a house on it, total cost, towards $1.5 million these days, that property is not going to be positive cash flow. Not now, not in the future, is not going to be positive cash flow. And if you're serious about building your portfolio, you have to understand that you can't build a large portfolio, 3, 4, 5, 6, 7 properties, if you're buying negatively geared properties. The same is true in Melbourne. If you're out buying new, blocks of land, and then building, those properties aren't really as high positive cash flow as what you can get in other parts of Australia outside Sydney and Melbourne. Brisbane, for example, Adelaide, for example, other regional areas, for example. So don't sacrifice positive cash flow. Even if your household earnings or income is $200,000, $300,000, even if you can afford the negative gearing, it's not a good idea from the bank's perspective. They will not allow you to buy so many more properties. That's number 1. Number 2, tax. Now I know what you might be thinking. You'll say, well, I am on a $200,000 income. I am on a $150,000 income. I am on a $250,000 income. By buying this block of land and by building, it'll be negative gear. I get some tax back. It'll be a brand new building, right? Tax is not the reason why we invest in property. For most people who are brand new to property investing, don't know so much, they fall for these ads where it says depreciation, you get your tax back, all this sort of thing. Sure, if you want to lose $2 to get $1 back or 30 cents back, that's a completely different strategy, right? You're effectively losing money to get a proportion of it back. Doesn't make sense, right? But if you want to grow your portfolio, you need positive cash flow properties. You can still buy positive cash flow properties that still get you some tax back. But the point is, losing $10,000 or $20,000 a year, even if it's due to depreciation, is not going to allow you in the bank's eyes, from a loan perspective, build a property portfolio. Remember, you have to give that depreciation back, at least half of it when you sell. So that's the second point. The third point is that if you're buying, property, even a block of land in Sydney, upwards of $1 million, in Western Melbourne, it's hard to get anything less than $500,000 these days, just the land. That is sucking up a lot of capital. Why put so much capital into one investment property? We haven't even talked about the build cost, right? We haven't talked about if you're buying a $500,000 block of land in Western Melbourne to then build, that's another $200,000-300,000, or even if you're buying a super cheap piece of land, 250, 300 square meters, and you're getting that with a build cost, with a building on top, with a house on top, for a total of $500,000-600,000. Still, there's no need to spend $500,000 or $600,000 for your first investment property. Why take all that risk in buying something negatively geared in a part of the city where no one really wants to go to? I'll get to that in a second. Why sink so much capital? And especially in Sydney, you're sinking in $1 million and $1.5 million. You could buy 3-4 houses like that with better growth prospects, with better positive cash flow, other parts of Australia. Okay, so that's the third point. The fourth point is vacancy. In Melbourne, even though the growth might be there right now or for the last year, between, let's say, places like Tarneit out to Melton, even though the growth may be there, when it comes to finding a tenant, people are having issues. Vacancy rate in places like Tarneit is like 5 or 6%. Even though that property is going up, it's sitting empty, or certainly rents aren't rising. Similar type of story, although not as dramatic, in Western Sydney, out past Kellyville North, out past Box Hill, in and around that, past Schofield's area. The vacancy rates are quite high. Okay, vacancy rates are quite high. I personally wouldn't go any further out than Quakers Hill, because vacancy rates become an issue. So even though your capital right now, in the moment in time with this property boom, might be rising in value, you will find it difficult to find a tenant. And from there on, when the property market mellows out, prices start to stabilize, that's when you really start to hurt. In 2023, 2024, 2025, when your property there worth $1.5 million is sitting there for a month empty, that's when you'll probably think, oh, look, PK was saying something in 2021. So that's vacancy. The fifth thing, is that the growth that is being achieved in Western Melbourne, that has been achieved but in out past Schofields, out past Box Hill, out past Ponds, in that kind of Rouse Hill area and Box Hill area surrounds, is due to macroeconomic factors, interest rates, government stimulus, and FOMO. How many Indians are trying to fight over that one block of land in Hoppers Crossing or in Box Hill? It is FOMO, it is not fundamentals. The growth there is driven not by fundamentals, but by FOMO. Now cast your mind back to 2018, cast your mind back to 2019, cast your mind back even to early last year. Those blocks of land that you guys are fighting for in Box Hill, those blocks of land that you guys are fighting for, just before Melton and Western Melbourne, developers couldn't sell them for free a year and a half ago, 2 years ago, 3 years ago. When you have an area that is so susceptible to the peaks and troughs of FOMO, that is an area that you want to be staying clear of, right? That is an area that in 3 years' time is going to start mellowing out. In 2 years' time, maybe, as soon as interest rates start going up, is going to start mellowing out. Another way to put this is, the people that are buying that, blocks of land in Rouse Hill, Box Hill, in Sydney, average incomes, let's say $150,000 to $200,000, IT professionals, can that $1 million or 1.2, 1.3, 1.4 million dollar property, land plus build, is that going to become a $2 million property in 5 years' time or in 10 years' time? Are those IT professionals that have a household earnings of 150 to 200K, is their income going to double to 400K? Ask yourself. I know plenty of you guys that follow me, you're also of an Indian background. Plenty of you aren't, but many of you are. Ask yourself, is my income going to double? Is that place going to be affordable if it's a $2 million suburb? Is Box Hill going to be a place where, two people in IT background, IT professionals, are going to pay $2.5 million for in 10 years' time? Is highly unlikely, because the income growth just isn't there in their salaries, right? So just take a step back and see things for what they are. See the fundamentals. not the FOMO, right? Even when the migration tap opens, it's not like these migrants from South Korea, India, China, other places like that are going to spend $1.5 million on a property in Western Sydney, in the first year, 2 years, 3 years of their working life. No, they'll rent, they'll establish themselves, and then they'll look to buy. And are they going to buy all the way out there? Maybe. Maybe not. Maybe they'll look to buy in Brisbane or other places. Maybe they'll look to find a townhouse closer to the CBD or closer to Parramatta. It's a gamble, guys, right? I know right now it seems that, it's great if you can even pick up a block under 700k in Sydney or 800k in Sydney. It's great if you can even pick up a house and land package under $500,000, in around that Melton area or further in from Melton. But see the forest from the trees. It's FOMO, not fundamentals. Timing. This is the sixth or seventh thing I want to talk about. The time to buy, if you were buying in those areas, was start of last year. All right. Now property prices in many of those areas have gone up 30, 40%. So if you're still looking to buy in those areas, you've missed the bottom by 30, 40, in some instances 50%. Why are you looking to buy? Don't just follow the herd. The herd who've already bought there might have lucked out, but you are too delayed in your decision making. Now it is not the right time to be buying there. Okay, the long-term fundamentals don't stack up. The predominant reason is building approvals and land. People often say to me, "Oh, PK, but Western Melbourne, you can't pick up a piece of land in Tarneit or Truganina or around these areas." Well, that's true. But check out the stock on market for established properties. There's so many properties for sale there. Not only that, but there is so much land, farmland paddocks, hectares and hectares of land that will be developed in the future, right? That is a recipe for subdued price growth over the medium to long term. Yes, short term, anything is going up in Australia, but you need to be very careful that it continues to go up after 2 years, after 3 years, after 4 years. And the fundamentals around supply in Western Sydney, out past Rouse Hill and those areas, and out past Tarneit or further west of those areas towards Melton in Melbourne is really weak. The fundamentals are weak. Supply is the enemy of growth. Right now, developers, they're drip feeding, they're slow releasing land, and when prices don't increase, what they do is they reduce the land size. They sell it at the same price, but a smaller parcel of land, from 400 to 350, then to 300. That's how they make money, and they create this artificial sense of scarcity. Whereas in fact, if you drive 10 minutes further, west, there's all these hectares and sheep going around the place. Right? You have to understand the fundamentals of supply. Supply is the enemy of growth. And the last thing I want to say is don't follow your friends. I know I'm not your friend, or maybe I am. Don't even follow me. But the reason I'm saying this is because just because someone else made money by booking a land with 5% deposit and they've made already $200,000, $300,000, they've done that because they bought last year. That doesn't mean that's what you will achieve now, okay? Don't take someone else's victory to be guaranteed for you if you're not investing at the same time that they did. Okay, what they did will not work for you anymore, most likely. You need to do your analysis yourself. You need to understand property investing yourself. 9.5 or 9.9 times out of 10, your money can work much harder for you if you spend under $500,000, ideally even under $450,000, buy in better value areas like Brisbane, Adelaide, maybe Perth, regional Victoria, regional New South Wales, regional Queensland. Instead of buying that $550,000 house and land package in Western Melbourne, or that $1.5 million house and land package or land plus build in Sydney, you can do much, much better by buying 2 or 3 properties sub $500,000 in these other locations that will give you positive cash flow from day one, that will also give you some tax benefits, that won't suck up your capital, that will have incredibly limited vacancy rates with rents rising every year, that will grow not only now but also in the medium and long term, that will allow the banks to give you more and more loans, your serviceability will be strong, and that are supported by fundamentals, okay? You may need to ignore your friends. You may need to, be a little bit of a maverick in your society, but no one cares about your money as much as you do. Not your friends, not that friend of a friend who recommended that agent, not that friend of a friend of a friend who recommended that builder. None of those people, not even me. The person who cares most is you. Every dollar is hard earned. I know it. I've been there. Okay, so get educated. Hopefully this video has brought you value, guys. If it has, and if you want me to expand upon these subjects and tell you exactly further reasons why you shouldn't invest in Melbourne and Sydney in the western parts, drop a yes below and I'm happy to expand it, just seeing if there's interest. Guys, subscribe, hit the like button, and please share this amongst your community so that more people can get value and not make wrong decisions. Okay, you'll see prices even in Western Melbourne, Western Sydney go up like this. They'll continue to go up, but this highly cyclical markets, they'll come right back down when the correction will happen. There are better areas to invest in around Australia where that correction won't be as profound or won't exist at all. My name's PK, and in the links below I'll drop a link to the Property Investment Accelerator. I have a thick pipeline, guys, if people want to work with me. Please don't book a call if you just want more information. Those calls are really for people ready to go. There's plenty of them. Okay, so please respect your time, respect my time. And also leave a link below if you're not wanting to pay me. There's so much education I provide, guys. There's more than 150 videos right here on YouTube. I have a podcast link below, Facebook group with almost 9,000 people. Plenty of free info there. Guys, heed my advice. Take care. Bye.